Okay, let's talk about the dream. It's 2026. You roll over in bed, you check your phone, and you see that you literally made money while you were sleeping. No commute, no boss, just cash hitting your account. That's what we're all after, right? Well, to get there, we've got to settle one of the biggest debates in investing. So let's just dive right. That's the real question, isn't it? How do you actually do it? This isn't about some get rich quick nonsense. This is about building legitimate, sustainable wealth engines. And today we're going to put the two most powerful wealth engines ever created into the ring, head to head, so you can figure out which one is the right one for you. So, welcome to tonight's main event. In this corner, weighing in as the heavyweight champion of tangible, touchable assets, and in the other corner, the undefeated challenger of the digital age. This is it, the ultimate showdown between the two absolute titans of building wealth, real estate versus dividend stocks. So let's meet our fighters. First up, you've got real estate, the tangible titan. It's simple, right? You buy a physical property, you rent it out, and boom, you get a rent check every single month. You can drive by it, you can touch it, it's real. Then you've got dividend stocks, the digital dynamo. Here, you buy tiny little pieces of fantastic companies, and just for being an owner, they send you a slice of their profits every quarter. Both sound pretty good on the surface, but as they say, the devil is in the details. All right, let's get right into the action. Round one is all about getting started. How hard is it, really, to even step into the ring with these two contenders? And wow, just looking at this, the winner of round one is beyond obvious. To buy even a halfway decent rental property in the US today, you're going to need tens of thousands, maybe even $100,000 for the down payment and all the fees. That's a huge barrier. Now, dividend stocks, you can literally start investing with $5. $5. So the clear winner of round one by an absolute knockout is dividend stock. Okay, on to round two. We're calling this the passive test because this is where we really separate the dream from the reality. Just how much work are you actually signing up for with these things? And this right here, this is the harsh truth for a lot of property owners. Let's be real, being a landlord is a job. I'm talking about that phone call at 2 in the morning because a pipe burst and there's water everywhere. You're dealing with tenants, toilets, and trash. It's anything but passive. Now contrast that with the life of a dividend investor. You buy the stocks and that's it. You do nothing. The money just gets deposited right into your brokerage account. No tenants call you, there are no repair requests, no messy evictions. It is the literal dictionary definition of passive income. So, yeah, the winner of round two is, once again, dividend stocks. So far, this is looking like a total blowout, but don't count real estate out just yet. Let's get into round three, where we look at the money itself. We're talking growth versus cash flow. Okay, so real estate pays you every single month, which is fantastic for paying your own mortgage and managing your budget. Dividend stocks, they usually pay out every 3 months or quarterly. But here's the secret weapon for stocks: dividend growth. See, great companies tend to increase their payouts almost every single year, often faster than inflation. Your rent can go up, sure, but it's pretty much capped by what people in your local area can afford. A great global company can grow its profits all over the world. So, for this round, we're going to call it a tie. It really just depends on what you need more, that steady monthly cash flow right now, or that long-term compounding growth. All right, I know the real estate investors in the audience have been waiting for this moment. Stocks are up 2 rounds to none with one tie. But this is where the tangible titan makes its dramatic comeback. Welcome to round four, the game changer. And it's all thanks to two secret weapons. Real estate has an ace up its sleeve that stocks just can't compete with, and that is the US tax code. You get to deduct the interest you pay on your mortgage. You even get to deduct for the wear and tear on your property, which is called depreciation. This means you can often end up paying almost zero taxes on your rental income, legally. But the real knockout punch is leverage. So what the heck is leverage? Simply put, it's using the bank's money to make yourself rich. You put down a little bit of your own cash to control a much, much, much larger asset. This is the absolute superpower of real estate investing. And here's why this is so insanely powerful. Let's say you put $50,000 down to buy a $250,000 house. If that house just goes up in value by 5%, you didn't make 5% on your money. No way. You made a 25% return on your initial $50,000 investment. That is the explosive, mind-bending power of leverage. Round four goes to real estate, and it's not even close. So, after a really hard fought battle, who is the ultimate winner? Well, now we go to the judge's decision to figure out your winning strategy. Because the best choice here really truly depends on who you are as an investor. Let's look at the final scorecard. Dividend stocks came out swinging, taking the early rounds with accessibility and being truly passive. Round 3 was a draw, depending on your goals. But then real estate came roaring back in round 4 with those incredible tax and leverage advantages. So, what does this all mean for you? Well, you should probably build your wealth engine with dividend stocks if you're starting out with less than, say, $100,000. If you want a genuinely hands off, set it and forget it investment. If you really value being able to sell and get your cash quickly. And honestly, if the idea of paperwork and managing tenants just gives you a massive headache. On the other hand, you should probably focus on real estate if you've already got a good chunk of capital saved up for a down payment. If you want to use that superpower of leverage to juice your returns, if you want to get your hands on some of the best tax breaks out there, and this is the big one, if you're willing to treat it like a business, not some passive hobby. The truth is, both of these are incredible tools for building wealth. They just serve different purposes at different stages of your financial journey. So the final question isn't really which one is better, it's which one is better for you right now. Your capital is sitting there, ready to go. Which wealth engine are you going to build first? If you found this video helpful, smash that like button. It really helps the YouTube algorithm, and don't forget to subscribe. Thanks for watching, and I'll see you in the next one.